Hello everybody, this is the first part of our new lecture dedicated to taxes, transfers and income distribution. With this first part we are going to focus on taxes. Taxes tend to be quite complicated. There are many taxes. I tried once to collect some information about taxes in Chinese economy, and I came up with the list of over 20 taxes. Quite a lot. But here in the slide you can see the most common taxes. This is like personal income tax, corporate income tax. We have them in most countries. Excise, value-added tax. These are also taxes that are pretty well known. Property tax, estate and gift taxes, especially when it comes to inheritance, when you inherit something after your late relative. Payroll tax, pretty popular in the United States of America. Some state taxes, federal taxes, also quite popular there. What are taxes for? We can distinguish 5 main functions of taxes. The first one, probably the most important, is the fiscal function. It simply means that taxes is the way for the government to collect money for the government budget. And therefore the government then may spend money through government spending, including public goods supply that we mentioned last time, and also transfer payments. Allocation function is more about redistribution. So this redistributory function of taxes is generally the idea of moving money from the wealthy to the poor, to correct for the income distribution performed by the market. This is the function of taxes we are going to focus on later. Regulatory function. It actually is based on stimulating and destimulating some groups of taxpayers. So for instance, we may like to use taxes to stimulate small business or stimulate domestic business if we want to protect the domestic market. We can also try to use taxes to destimulate, to discourage some groups of taxpayers from doing something, from carrying out some economic activities. Controlling function is mostly about information that decision makers and the government itself may obtain through taxes. So we can, for instance, try to investigate what are the major sources of income for people. What is the importance of those different sources of income. We can investigate value-added tax gap, the difference between the amount of value-added tax that should be paid and the quantity, well, the amount that is actually paid. We can see, for instance, the revenue from personal income tax decreasing, which may signal some problems in the economy, because evidently personal income tax, when it goes down, then we see that people get lower income. So that is a kind of signal that the government can capture. And the last function, incentive, it is often linked with the regulatory function or stimulating. So incentive, stimulating, they tend to be perceived as the same, but actually this incentive function is kind of special taxation for some special groups, like you have special way of taxating actors and other members of creative industries, or veterans, for instance. may be privileged to some extent with taxation. So this is the incentive function of taxes. How important are taxes in this fiscal function? So how important they are for the budget? Well, if you look at Polish budget for 2017, you will see that 90% of all budget revenues comes from taxes. So this is the vast majority. And if you check data on other countries, you will see it's quite similar. So taxes are an absolute fundamental thing for making government budget. You may wonder what is this non-tax revenues here that account for nearly 10%. That could be various things, but most often this is money gained, profit gained by state-owned businesses. This could be profit of the central bank that is paid to the budget and becomes one of the revenues. But nevertheless, this is just 10%. So we heavily depend on taxes when it comes to government budget revenues. Let's have a look at the composition of tax revenues. So now in this pie chart, you have this 90% of the budget. As you can see, the dominating blue color is for indirect taxes. Well, what are indirect taxes? What is the difference between indirect and direct taxes? Direct taxes are paid directly, hence the name, by taxpayers. So if you are employed, you earn money and then you have to pay your personal income tax. You run a business and you pay corporate income tax. These are direct taxes. It's like you have a dog and you pay a tax. You inherit a flat and you pay a tax. Well, you don't pay it in Poland if that is a close relative, right? But nevertheless, that could be the case. Indirect taxes are not paid in a direct way. So these are value-added tax and excise tax in the European context. And those two taxes are included in the price of goods that we buy. So in fact, when you buy milk, you pay some tax. When you buy car fuel, you pay some tax. But it is included in the price. You don't pay it directly to the government, you pay it to the seller. And sellers would pass this tax further on. So as you can see, indirect taxes are very important for budget. They are a very important source of revenue. And in fact, what you can see, this is this kind of general tendency that countries tend to rely more on indirect taxes and gradually less and less on direct taxes. This is for many reasons, mostly psychological reasons, because the psychological impact of direct taxes, and that is a negative impact, this psychological impact of direct taxes is much stronger. So it is better to collect money through indirect taxes because this is less visible, less painful and less de-stimulating for consumers. Have a look at personal income tax schedule. You see this is slightly outdated. But in fact, in Poland, personal income tax nowadays is very simple, relying just on two marginal tax rates. So I decided to use an old example to show you. And remember, in many countries, personal income tax nowadays looks like it was in Poland in 2007, let's say. There are a few tax brackets. You've got 3 tax brackets here in this example. There is a little tax exemption, meaning there is a certain threshold below which you do not pay tax at all. For each tax bracket, you have a corresponding marginal tax rate. So in our case, this is 19 for the lowest tax bracket, then 30, then 40%, respectively for higher tax brackets. So if you earn below 3,015, you don't pay any tax because your income falls in personal income tax exemption. If you exceed this limit, then you pay your tax, and if you are in the first tax bracket, you pay 19% of your tax. However, this 19% is calculated only from the surplus money over this 3,015. So for instance, if you earned 3,115, which means that you exceeded the level of tax exemption by 100, then the tax that you would pay would be 19% of 100, which would be simply 19 zloty. That would be your tax. That's why you can see the taxation in the first tax bracket is 19% minus 572.54. This 572.54 is simply 19% of the tax exemption. This is the money that you will not pay. And similarly, if you exceed the level of income of 43,405, so if you enter the next tax bracket, then you will pay 30% as a tax. But this 30% will only apply to the surplus over 43,405. For the rest of your money that is within the first time bracket, you still pay 19%. That's why we call those tax rates 19, 30 and 40 marginal tax rates, because they apply to additional money. So 30 applies to additional money over 43,000. 40% is the tax rate that applies to additional money over 85,000, and so on and so forth. Well, so taxable income is the income of a household minus exemptions and deductions. Exemption, this is something that we already discussed, right? This is the certain amount of money that you can earn, this part of your income, some kind of income that is not subject to the taxation at all. What are deductions? Deductions, that's money that you spend on some things that are entitled to be subtracted from taxable income. This is about stimulating function of taxes. So for instance, the government wants us to use a lot of internet to make the society more digital. All right, so it is possible that they would say, well, if you spend up to 1,000 of your income on internet access, then this 1,000 or the money that you spend on the internet access can be deducted, can be taken out from taxable income. So we could say the money that you spend on internet access is money that will be not actually taxed by the government. So this sends you a kind of incentive here. What is the average tax rate? This is the total tax paid divided by the total taxable income. Average tax rate tells you what part of your income you actually paid in the form of a tax. Obviously, average tax rate is different from marginal tax rate because marginal tax rate applies only to additional money. So coming back to our schedule, if for instance you earn 6,030, which is twice as much as personal income tax exemption, then you will pay 19%, this is marginal tax rate for your income, but you will pay this tax only from the half of your income. You will pay this 19% applied only to 3,015 because the other 3,015 is your tax exemption. So the average tax rate in your case would be 19% divided by 2, which is 9.5. So that is the average tax rate when you earn 6,030. That would be 9.5. Marginal tax rate being 19. When you look at various types of taxes, we often distinguish flat tax. Some people call it linear tax. Flat tax would be the system of taxation where marginal tax rate is the same for all levels of income. So you do not have tax brackets actually. There is one huge tax bracket and everyone pays the same marginal tax rate. Remember, paying the same marginal tax rate does not mean that the average tax rate is the same for everyone. It doesn't have to be like that because of exemptions and because of deductions. So generally speaking, we could say there are three types of taxes: progressive, regressive, and proportional. It all depends on the question, what happens to the share of tax paid in taxable income? What happens to the average tax rate, in other words, when income increases? Progressive tax systems are the systems where average tax rate grows with the income. So the bigger is your income, the bigger part of your income you pay in the form of a tax. And this is what we kind of often see. I mean, most income taxes are made to be progressive. This is important for redistribution of income. Regressive tax would be the other way around, meaning the more you earn, the smaller part of your income you pay in the form of taxes. This kind of regressive tax system is not something we want to have normally in the economy. Well, it happens sometimes that due to some regulations, some taxation systems may prove to be regressive. It is possible, but this is actually wrong taxation policy. And proportional tax, this one is often called linear. Okay, the share of tax paid in taxable income is constant, regardless of the level of the income. So the average tax rate is the same to everyone. And remember, flat taxes with one marginal tax rate, they don't have to be proportional. Actually, if you want to have proportional tax, you need one marginal tax rate which is flat tax, but you also need to get rid of any deductions and exemptions. If you do have deductions, if you do have exemptions, then you don't have proportional tax, because average tax rate would be different then. There is no clear answer to the question which type of taxes is the best. Some would, for instance, claim that regressive taxes are very good because people do not hide their income. Pretty logical. The bigger is your income, the smaller amount of money you would pay, actually. Right? Proportional taxes are gaining some popularity, but actually most of taxes are progressive. It can be shown that they are the most fair tax system, right? So when it comes to fairness and justice, progressive taxes are best, and this is something we can obviously discuss during our online meetings. If you look, for instance, at personal income tax in Poland, and this is basically what we have right now in Poland, two marginal tax rates of 18 and 32%. As you can see, this personal income tax system is actually a flat one, because more than 97% of taxpayers are subject to 18% marginal tax rate. So we could say the question of being progressive with regard to personal income tax in Poland, the question of being progressive applies to less than 3% of taxpayers. On the other hand, look at the differences in the contributions made by this low income and high income groups. Less than 2.5% of taxpayers give nearly 25% of the whole personal income tax income to the budget, revenue for the budget. That's quite a lot, right? That's quite a lot. And also look at the difference between effective tax rate and marginal tax rate. Effective tax rate is actually what part of their income people really pay. So this is 7% for 18% marginal tax rate and 15% for 32 marginal tax rates. Remember, there might be several significant differences between marginal tax rate and what people usually pay. Okay, so this is what we wanted to say about taxation. We will give some more of our attention to taxes when we talk about fiscal policy, but for income distribution that should be absolutely enough. Give me a like if you liked this lecture, and let's stay tuned. Thank you. Bye-bye.